one of the more interesting facets of my job is to host different perspectives. And I like to just point out that the equity markets have hit a new all-time high last week.
Yep,
Friday. Consumer sentiment is rising at a pretty fast pace. Unemployment rate is still low. The jobs market is not looking weak right now, although the tech companies have been undergoing some layoffs of late. Retail sales have hit new highs in nominal terms. Consumer debt has hit new highs. That could be, debatable whether or not that's good or bad. Credit card delinquency rates have been rising at the fastest pace since before the pandemic. It's now at near pre-pandemic levels. So that's a negative indicator. So on both sides of the aisle, you've got negative and positive indicators, just depending on how you want to look at it. So I just want to open the discussion with Adam by noting that it's not all doom and gloom on my channel, and Adam's as well. There's a lot of different perspectives out there. And I personally, if you were to ask me where I think the macro landscape is looking, I don't think we're heading towards a major hard landing just yet. At least there's no data to suggest that. I'll pass it over to you, Adam.
Great. It's interesting. And let me preface this by saying, there's a ton of experts here at this conference. I don't necessarily see myself as one of them. I see myself as really an avatar for all of you. My role in my interviews is to try to just put myself in the place of a regular person who's just trying to understand where the puck is headed so that I don't become collateral damage to anything bad that might happen, or that I can take advantage of something good that might be in the works. Hopefully, if I do my job right, I'm asking the questions that you would be asking if you were sitting down with this person. Now, that said, David and I get to spend a lot of time with these smart experts. And if anything, maybe we become experts of experts, where we kind of know what a lot of these different folks are thinking. And it's funny because I can sit down with somebody who's got a pretty bullish outlook and wants to focus on, the strong numbers, the strong side of the numbers that David just listed there. And I can walk away from that discussion feeling like, oh, maybe it's not going to be so bad, right? And then I'll sit down with somebody else and say, oh my God, the wheels are coming off tomorrow. This is going to become a dumpster fire. And I guess if I could kick this off, I'd say I'd borrow from the words of Stephanie Pomboy, who basically said that coming into 2024, she is the least certain of what's going to happen than she has been in any year of her career. And I've heard that echoed by other people. There really is enough data out there to support almost any point of view at this point, because there's a fair amount of good and there's a fair amount of bad. I would say in general, the folks that I talk to are pretty. They don't think the wheels are going to come off anytime immediately, right? And so I would say I've seen a growth of folks saying that, at Q1 it's going to be pretty darn strong. Guys like Darius Dale, who have a 3-month focus. Darius's words, he's the most bullish he's ever been in his career. Even folks that expect things to get not so good later on, like Felix Zulauf, he said, look, he thinks Q1 is going to be the high water mark, probably the end of Q1. In fact, he said, I think it's as the quarter goes on, euphoria is going to grow. The economy is going to look stronger than folks expected, and he expects stocks to hit S&P just hit a new all-time high, but he expects them to set a materially new all-time high from where they are right now by the end of the quarter. Now, again, in Felix's point of view, that's when the wheels start coming off and the rest of the year looks very different. And I think as an investor, that's the big challenge you have right now, right? Is do you bet on the soft landing, no landing, or do you prepare for something harder than that? I'll show my cards, and again, I want to reiterate. I'm not necessarily an expert that you should be building your investment portfolio around. You should definitely be listening to the people that I talk to much more than me. But here are some of the things that I'm hearing recently from folks. One is I'm increasingly hearing a concern that inflation is not conquered, and that I don't know if anyone caught my recent interview with Lakshman Achuthan, who studies economic cycles, but he just says, look, inflation is cyclical. It's just the nature of inflation. And if you look back at the 1970s, where we had that kind of roller coaster set of ever increasing resurgence in inflation, He sees something kind of similar happening from here. And if he looks at the global inflation data, it's all bottomed. The only place it hasn't bottomed yet is in the US. That said, we just had the Fed basically come out with a dovish pivot policy-wise and is now expecting to cut 3 times next year. And of course, the market thinks it's going to cut like 6 or 7 or whatnot. And we can talk about whether that makes any sense or not. But whether it's him, whether it's guys like Dave Bianco, who just think that the world has fundamentally changed, and the cost structure of the world with onshoring, reshoring, increasing global instability, like we're seeing in the key shipping routes, like around the Red Sea right now, things that are just going to be secularly inflationary and keeping costs higher than we've been used to for the past couple of decades. If indeed the Fed starts easing into that, if it starts cutting like it says it's going to, we've seen the trial balloons come out in the past week or so about ending QT now, right? That then possibly, that doesn't help in bringing down any secular inflation trends. It makes it easier for that secular inflation to rise if the Fed, stops hiking and stops cutting. So I think, figuring out where inflation is going to go is going to be a big part of the story. Obviously, where inflation goes, interest rates go.
What do you think? What do you think drives inflation, Adam?
Pardon me? What do I think?
What do you think it drives inflation?
Well, I think we've learned. There's the famous Friedman quote that inflation is everywhere and always a monetary phenomenon. I think if you're asking about inflation as we, the consumer, experiences it, I think we've gotten kind of a crash course in the fact that. Yeah, there's definitely a monetary component to it, but we just spent a decade of QE 1, 2, 3, 4, where I don't want to pretend like the cost of living didn't go up in ways that mattered to people, but it really didn't go bananas until we had the fiscal side of the equation kick in, right? It was once money was being injected directly into the economy, that's when it really took off. And at the same time, we had cost push inflation from the breakdowns of global supply chains. So I do think it is a more complicated soup than just print or go burr.
Let's poll the audience. I mean, we're both interviewers. Let's interview the audience. Raise your hand if, I'll give you a few variables and you'll rank them based on your concern. So if inflation is your top concern still for 2024, raise your hand. So not many, right? Inflation's been coming down. Raise your hand if you're concerned about a major recession in either Canada or the U.S. A few more hands. Raise your hands if you think that there's more like a depression. Okay, well. We're trying to be nice. It's not even 10 minutes into the session yet. We'll get there. Raise your hands if you think that there's going to be a real estate crash somewhere. Well, we're in Vancouver, so that's kind of a biased question. Raise your hand. The junior minors have had a bad year last year. Raise your hands if that's still a concern for you, if you think the juniors will continue to suffer. Okay. So then by that extension, do you think the equity markets will have a major correction? Like we just said, there's going to be a... Raise your hands if you think there's going to be a big stock market crash. Okay, so people here are concerned about risk assets falling and a real estate bubble. Not so much about inflation, a little bit about a recession. Last question, who here thinks gold is going to go way higher this year? Okay, I guess we're speaking to the wrong crowd, or the right crowd.
I was going to say, it is a resources conference. I would have been worried if less hands went up.
Bitcoin, up or down? Bitcoin. Okay, all right. Fewer hands.
The question is do we expect Bitcoin, the price of Bitcoin, to be able to be manipulated more now that there are these new ETF products that are out there? I don't want to put myself out there as any real crypto expert. There are far better ones than me here. But my short answer to that would be yes, as time goes on.
No, there's other ways that people would have manipulated the price already. I mean, it's no.
No, you're not worried about big players getting in there and pushing quote unquote the paper price around, selling short.
Well, they could already do that. So the ETF for any commodity, Bitcoin being labeled as a commodity by the CFTC, is just one avenue of investing. Certainly, it'll bring in I can't remember the number exactly. I don't want to misquote a number, but it was a substantial amount of inflows into the ETF within the first week of launch. One of the most successful ETFs in history, but it's still not that much money compared to other ETF products already in existence. And so, if you consider the fact that large institutional players could already buy either futures, they could buy Bitcoin proxies through MicroStrategy or Bitcoin miners. If you're a retail investor, you could buy. You could buy the spot price, of course. The large whales are typically not all of them are institutional players. They already controlled, a significant minority of the Bitcoin float. So the ETF itself is just another instrument to do what's already been done.
Well, I would listen to David more than me because I am not a Bitcoin expert. So one of the other big factors, and actually, David, I'd love your thoughts on this, is liquidity. Right. So again, we have the ability to kind of tell you what the current consensus sentiment is amongst the experts, because that's what we do every day. We've got our finger on that pulse. Coming into 2023, the vast majority of folks that I was talking to were exceptionally confident that there was going to be a recession early in 2023. Of course, we didn't have it, and we had a great year in the markets, right? And I believe now, kind of Monday morning quarterbacking that, a huge part of that was due to just net liquidity in the system, and that net liquidity rose pretty much. It bottomed out in October of 2022, which is right when the markets bottomed, and it rose pretty much throughout all of 2023. Now, what's interesting about it is there's not an easy gauge of liquidity, and a lot of the folks I talk to who track it kind of all have their proprietary ways of tracking it. The big question going forward is, well, if that really has the power to overwhelm kind of everything else, well, then what's liquidity going to do going forward, right? If we can know what's happening to liquidity, we can hopefully have a really good sense of where the system's going to go going forward. And it's an election year in the States, big election year. So if they can keep everything supported, you would think that they would be doing that if they could. You talk to guys like Michael Howell, and by his measures of liquidity, he thinks it's going to go up for the next 2 years. He's actually very bearish for both the economy and the markets for the next 2 years. Now, I've talked to other people who don't think it's nearly going to last that long. I've talked to some other people who think that a lot of the big issues, you talk to Danielle DiMartino Booth, for example, there was about 1.3 billion being pumped into the economy. 1.3 trillion being pumped into the economy by both the PPP program in the States, but then following on from that, the employee retention program, which was sort of one of these many stealth stimulus programs that was going out there that many of us didn't really even realize existed. So she's saying that's kind of ending, and so there's a large part of the tailwind that's been pushing liquidity out there that's going to start going into reverse. So it really kind of matters who you listen to and what their outlook for inflation is, in terms of determining what you're going to decide. But I'm curious, David, what are you hearing from folks about liquidity?
Not much of a problem, really. Yeah. We had a liquidity crunch in 2008. The banking crisis of last year wasn't so much liquidity, it's just banking mismanagement of treasury duration mismatches, right? Bank credit has been declining. The money supply has been contracting for the first time since the Great Depression. Certainly that is a cause for concern, but I don't think we're going to get a major liquidity crunch. For that, you'd have to, first of all, the bond markets are much smarter than myself, okay? And if you look at the Bank of America, for example, the Bank of America ICE high yield option adjusted spread, it's not moving up. Credit spreads are not moving up. The bond market is basically telling you there's not much elevated risk right now. I wouldn't say liquidity is a concern. But you did bring up several interesting points, Adam, which is how do we gauge risk? We can take questions at the end, but hang on to that thought. There are several ways to gauge risk. Adam, I'm curious to get your perspective on what you think are the biggest factors driving investors' risk assessment today.
Let's see here. Factors in driving investors' risk assessment. How much time you got, right? There's
You spent a few minutes talking about media, by the way.
yeah. But look, so there's valuation risk right now, right? I mean, we've got valuations at extremely stretched levels. We've got maybe more geopolitical risk than we've had for a good long while. Systemic risk. I agree. We don't. Well, again, this is kind of a good question. I brought this up at my panel earlier in the day. Did Powell switch to telling a more dovish tune because he does feel really confident that he's engineering the soft landing, or is he concerned?
I interviewed Judy Shelton recently, who was the previous economic advisor to Donald Trump. She was nominated by Trump to be a member of the Federal Reserve Board. Didn't go through. Very well-known economist. Anyway, she believes that, she insinuated during the interview, she didn't say outright, but there was a lot of political pressure by the Biden administration on the Federal Reserve to ease monetary policy into this year, right? As you know, inflation has already been coming down before the Fed funds rate dropped. And so one could argue it's not necessary. One could also argue there's a lagged effect, and so the Fed is easing into what they believe could be a recession because of tightened monetary policy from 18 months ago. But some people believe that the Fed and Congress are not as separated as they should be, and so there's political pressure. So that's one side of the equation. Let's move on to another topic, if you don't mind. I'm just curious, based on personal interest, who here watches mainstream news regularly? Raise your hand. Wow. Okay. This is honestly shocking to me. I mean, nobody raised their hand.
Are you guys mainstream?
I wouldn't know. Wow. Okay. How do you respond to this? What's your response to this?
Well, to me, this is exactly why I founded Wealthion 2.5 years ago, which was the company I founded before I'm now doing Thoughtful Money, which was, how much time we got here?
5 minutes.
5 minutes. Real quickly, I don't know what it's like in Canada, but I guess it's very similar. Our education system in the States gets an F in basically teaching practical financial literacy to people. And so, people basically graduate, they get out into the real working world, and they realize, oh my God, I am completely untrained and unprepared to be a steward of the money that I'm starting to make now here. And so, nervous like that, people start trying to self-educate, and they go and they watch traditional financial media. And more, they feel like the trust is being broken between the traditional financial media and the viewership. Take a place like a CNBC, which is probably the place I hear pilloried the most by my viewers, where no matter what happens in the market, it's always a great day to buy stocks. And why is that? Well, because their major advertisers are these big ETFs who want you to buy their product, right? And really what they're generating is entertainment, right? They're just trying to get as many eyeballs to watch CNBC as they can. So they're just pushing for that quick triggering soundbite, and then they move on to the next topic, right? So they're not really giving you anything that I would call financially nutritious in terms of content that you can use and apply. So that opened the door on, so basically people are abandoning those traditional media sources and looking elsewhere. And I think that's why we saw so few hands rise up there. Thank you for the clapping. But that's what we're creating online, right? Is we're trying to create the place where you can take enough time, as much time as needed to really suss out the important elements of whatever topic that we're talking about. Where we can bring in the experts and not force them to, give you their best 30-second soundbite and then leave, but to really exhaust the topic in a way where you feel like you got the key actionable insights that you needed from the conversation. So that's what I think about it, which is, it's basically their disgruntlement with traditional media that is allowing us to do what we do.
I don't want to hold up the panel because we're out of time, and I know the next speakers are already here, but I just want to end on this note. I completely agree with Adam. One of the key facets of mainstream media that I think is not good enough is that they don't take into account what the viewers want. There's not enough engagement and interaction with the viewer. So I encourage everyone to reach out to Adam afterwards and myself directly. If there's any topic that you're passionate about or want to learn more about, we'll try to make it happen on our show and try to educate you. So thank you for being here.
Thank you. Any questions? We'll be right outside.